You're watching Business Morning on Channels Television, broadcasting live from Lagos. We're now been joined by the Executive Secretary of the Financial Markets Dealers Association, Wale Abi. Good morning.
Good morning.
Thank you for coming on the program.
My pleasure.
While I was going on break, I told everybody that your market is very lucrative. I think people are more comfortable putting their monies in the money markets now than having to go to the equities market, even if we have seen some remarkable growth in the equities market itself. What do you think is responsible for this?
Well, it's quite simple to tell. We shouldn't forget the experiences that Nigerians who invested in the last 5 years or so had when the capital market collapsed, especially the stock market. So people are yet, to get out of the fear factor. But we should not, again, forget the fact that it's riskier when you invest in the equities market. The difference majorly between the money market, which is a short end of the market, and that of the long end of the market, is that you could invest your money in the money market and sleep with your two eyes closed because the risk is lesser. Of course, in terms of returns, the returns lesser as well. So there is a relationship between risk and return.
The returns is less, but you've seen interest rate of about 16% in the sale of treasury bills. Does that really mean that you wouldn't make as much money as...
The market is expected, the norm in the market is that you should have relative stability in that market. But when there are some sudden policy changes, then you have a kind of volatility over a short period of time. In other words, the market will react to the shock and then over a short period of time correct itself. For instance, in August, you were having rates even as high as about 24%. But what happened? With adjustments, with adjustments, the market correcting itself over time. Within a period of about a week, you discover that the rates, moved downward significantly. As by this month, for instance, instead of a comparable rate of about core rate of about say 18-19%, which we experienced at a particular week in August, you having rates now at about say 13%.
No, I think the core rate, the last figure we got from your people, is that the core rate was at 10.33%.
Yeah, that's I'm talking about the average for the month of September.
And I just want to know the decision of the central bank to keep its key rate unchanged at 12%.
Yes.
Did it have any form of impact at all on the money market?
Well, it's not the decision of the central bank must be looked at from. You are not going to take a look at only the MPR alone. You take a look at other decisions that were taken. Okay,
in terms of cash reserve ratios of banks and the net open positions.
Yes, so all those decisions that were taken obviously impacted on the market. The kind of rates we were seeing before, you discover that those rates have been adjusted as the market has corrected itself. And based on some other, there are some guidelines, aside from those policies that are from time to time reviewed, you equally have some guidelines which from time to time are looked at together with the stakeholders, the major stakeholders, the money market participants. And so what you have is a correction of some of these issues that possibly affected the market in the month of August.
Okay, I think at that point, though we realized that there was some level of liquidity squeeze in August, illiquidity, as we've seen the central bank issuing a circular to tighten liquidity but not allowing banks to access the WDAS window, while simultaneously also trading or rather transacting a CBN repurchase agreement such that injection of the FAC in the third week of the month could not douse the rising rates. You mentioned the rate was about 24% in that. Why do you think the banks would do such in terms of having to transact on the central bank window and also lend, or rather borrow money at the interbank?
No, the market is an open market, and then the dealers and treasurers will obviously go by the rules and policies of the central bank. So there was nothing against such before then. And so when like I just said, when policies are reviewed and then guidelines issued, to as a result of maybe some what has been observed over a period of time, or given the kind of short-term goals that the central bank wanted or needed to achieve. So that was exactly what happened.
Now, it seemed that directive made liquidity reduce as well, among the banks especially. Yeah,
that's what I describe as when you have sudden changes in policy and you have a review of a guideline that could create, immediate shock in the market. Then obviously that's the kind of thing you expect. But what has happened? You discover that the market is far, far better now. And in actual fact, the foreign exchange market, what actually gave rise to that kind of decision then was the fact that there was a lot of pressure, in the foreign exchange market. And since then, you discover that the market has stabilized.
Now, just of recent, not too long ago, we saw involvement of foreign institutions or foreign investors, as we want to call them, in the equities markets. One of the reasons that was given for the remarkable growth we've seen in the past few weeks is that we've seen inflow of funds from foreign investors. Now, I want to believe that was also that also affected the money market itself. Did the inflow of funds from foreign investors have any direct or indirect impacts on the money markets and the rates that we are having?
Of course, yes. It's all part of the money market. Given the fact that if a lot more funds, is available in the system, then obviously part of that, those funds will find, you have those funds distributed in the various segments of the market. But there's a relationship between the equities market and then the money market itself. If rates are very high, you are likely to have investment, going down, which you see in the pricing of stocks in the equities market, because a lot of people want to take advantage of very high rates in the money market. But like you have just said now, what has happened is that rates have come down significantly. And so you have some investors, who might want to now take advantage of the equities market as different from the rates, which are not as high as what you had before. But largely, we should take a look at the holistic market. In other words, majorly, the Nigerian markets generally, equities market, bonds market, the treasury bills market, and these various segments, you discover that foreign investors are having a lot more interest in these markets, given the kind of returns. And of course, one of the immediate benefits of Nigeria, the JP Morgan listing government bonds as in its index, is the fact that this has further opened up the Nigerian market in terms of the investors, foreign investors having to take a deeper, interest in the Nigerian market, because before you can be listed at all, before any market, or issue can be listed in that index, is an indication that the market is liquid. It's an indication that the market is transparent and open. And so these attributes are attributes you find in developed markets.